Mumbai.
Hello and welcome to the Financial Advisor Forums 2015-16 presented by UTI Mutual Fund and CNBC TV 18. And we are bringing you our fourth and final forum of the season from the financial capital of the country, Mumbai.
Financial Advisor Forums reaches out to independent financial advisors across the country. And in its 7th edition, the forums have travelled to the 4 top metropolitan cities of India. Having covered Delhi, Bengaluru and Kolkata, the forum comes to Mumbai to discuss how independent financial advisors can scale up their business, reach out to younger investors and adopt technology to serve their customers better.
Hello and welcome to the fourth and final Financial Advisor Forum of the season, and we're coming to you from the financial capital of the country, Mumbai. And we have a power-packed panel lined up for you. Joining me on the panel are Rajiv Anand, Group Executive and Head, Retail Banking, Axis Bank. Vineet Arora, Executive Vice President, ICICI Securities. Leo Puri, MD of UTI Asset Management Company. And Karan Bhagat, MD and CEO, IIFL Wealth Management. Welcome, gentlemen. Let's kickstart things. Mr. Puri, if I could get you to first address this. Times are changing. What the earlier generation used to invest in is not what this generation always invests in. What about the IFA? How should the IFA tweak themselves when dealing with a client who is bombarded by so much information overload, you could say?
I don't think the basics of the role of a financial advisor change. Tastes may change, behaviors may change, but the elements that go into being a trusted advisor are reasonably constant. You of course have to start with understanding who you're dealing with, what their risk appetite is. So there's no one size fits all. If anything, there's an even higher need for customization today than there may have been earlier. So I would say it's back to the basics, even more so as you get more complex products. Build a good needs analysis, understand the risk appetite of your investors, and above all, remind yourself that you're acting in their interest at all times.
Mr. Anand, if I could get you to comment on the same thing.
Regulations are becoming tougher and tougher. Making money is becoming tougher and tougher as an IFA. But look at the other regulations that are changing. One is that this whole regime of administered savings, the government will take care of my savings. I think those days are pretty much over, and I think the last nail in the coffin of administered savings, small savings, being freed up is really the last straw. So what the government is basically saying is that if you want to beat inflation, you have to take some risk, and that risk has to rest with the investor, and it's no longer going to rest with the with the government. The other is taxation, which used to drive investing, is also changing, and I think sort of the tax breaks that financial assets have been getting over a period of time are going to go away, and we will get to a more level playing field over a period of time. And so therefore, in that context, how does a average investor who's got some savings figure it all out?
Yes.
And I think now as you're trying to beat inflation, you will need advice. So it's just about going out there and reaching out to these people, explaining what inflation is, building asset allocation for them, and holding their hand through volatility.
Mr. Arora, I want you to add on to this.
So the earlier role of an IFA was primarily distribution. So just reach out, fill up a form, fulfill that entire transaction. But now the role has evolved into a much more complex role where you have to understand, you have to advise on specific stuff, asset allocation, and which is more customized to everything. So I think the role has evolved. Coming to your question that when an IFA is dealing with a informed investor, and that's where the debate starts. So what we also have to understand is that whatever I tell now to a client is not going to be just accepted as a piece of paper, and I will just say that okay, this is fine. I'm expected to receive some questions from the client now, which will say that why this scheme or why this fund, what is the underlying holding. So obviously the entire knowledge of an investor base is going up, which is good for us because that awareness that we had to first talk about investing in equities is now up to a certain level. Now it is more of taking that final decision along with the client. But what it has an impact on us is that we need to be much better prepared.
Mr. Bhagat, in situations when the markets are tanking, what does the client is definitely losing his cool and is getting so unnerved. but the IFA has to be rock steady, help that client. How do you advise those IFAs during those turbulent times to hold their ground?
I think a function of holding the ground at that point of time is also related to the selling process at the point at which the client got into equity. I think that's also extremely critical. I'll just take a step back. I think most investors in India today still continue to be first generational in nature. So even today they end up having at least on an average 50 to 70% of the assets in fixed income, tax-free bonds, and so on and so forth, fairly simplistic instruments. There we've got an opportunity because earlier it was parked in fixed deposits, private loans, ICDs. Now a lot of clients have moved away from those totally and are finding its way through tax-free bonds. The amount of leverage with investors is also reduced substantially, and therefore, coming to your question, I think the broader ability I've seen in the last 2.5, 3 years, 10-15% fall over the last 3-4 months, I think investors were much more stabler. I don't think so they lost their patience as much as they lost in 2008-9. I think the exposures in general as a pie of 100 was substantially more in 2008 or 2009 than what we saw today. Investors were smarter about broad EPS numbers on the index. I think what IFAs can do extremely well, which all of us do as some way or the other, is we have a scientific process to invest. So theoretically, for example, possibly 80 to 85% of the time the market's traded between 15 to 19 times of the forward EPS. Okay. For example, when the market falls down to 7,000 and the current year EPS is 500, and if it goes down below 7,000, if it's captured in a piece of document while the client starts investing and he realizes as a process he needs to stay invested when the P multiples are between 15 to 19, his ability to stay invested when either event below 15 happens or his ability to disinvest at the right time when the north of 19 happens improves substantially. And I think that education can't happen on the day it falls. It has to pretty much start by developing a simple 1.5-2 page what we call as an IPS, investment portfolio statement, for every client right at the beginning. And there, very simple things like asset allocation, liquidity requirements, and credit risk. Okay, as long as these three things can be captured on that piece of paper, and in a regular review on a quarterly basis, if these three can be measured for the client relative to his objective, I think it can go a long way in managing the volatility of the client.
It's time for a short break, but don't go anywhere. We'll be right back.
I think the biggest mantra in our business is to be with the client at all stages of his investments. So when the portfolio is up, portfolio is down, it's the most opportune moment to go and talk to the investors and explain to them what is happening in the market. I think the biggest mantra is always be with the client, be on his side, and talk to him as much as you can.
Welcome back. You're watching the Financial Advisor Forums 2015-16, and we're coming to you from the city of Mumbai. Mr. Puri, recently there's been talk of these the small savings schemes. The rates have come down, which is people have not been happy about that. Do you think this is also a good opportunity to talk about this need to invest in equities?
No, I think actually any move towards more market alignment is clearly going to get people to think about the relationship between risk and reward more rationally. In fact, it's a big disservice to the whole financial system to have anchor products, whether it's EPF or small savings and so on, which are materially misaligned and which continue to perpetuate the notion that you can somehow dispense with risk and continue to expect a guaranteed reward. And there's been many studies that have done as to how significant the misalignment is in terms of consumer understanding and behavior in India about the relationship between risk and reward. So market alignment helps bring that clarity, that if you're willing to take a little bit more risk, quite simply, you have a higher probability of getting a little more reward. You need to learn how to do that and make trade-offs around issues like volatility. And that's where a little more complexity comes in, because there are some products which will give you a little more reward with a little less volatility, which is well suited to typically households and middle class investors. And that's the kind of navigation that a good advisor will help you with. So fundamentally, the dialogue with an advisor is about helping you discover where your risk appetite lies. And as market alignment in terms of the risk-reward sort of equation develops in India, that dialogue will become more and more meaningful, more and more important, and getting those judgments wrong will, rightly in my view, become more and more expensive. And I think in effect what the government is doing by moving to market alignment is making it more expensive to be lazy about how you make investing decisions, which is absolutely correct.
Mr. Arora, the idea of an IFA moving from just being having a transactionary role to moving into an advisory role, has that time come?
Yeah, I think definitely. And, the time is now than it was earlier. And going forward, it's going to be even more important for the IFA to play that role. The role in a financial advisor is a much more intense and much more engaging role. And you need to, understand the portfolio, maybe keep on fine-tuning it, understanding if the needs are changing. And based on that, you have to keep on doing that. And that's the real value which an advisor adds today. Especially in India now in the last 1.5 years when the real rate of returns have now, come into positive. Which means that you've seen significant amount of money which used to go into physical assets like gold and real estate, shifting towards financial assets. Next stage is that, once these small saving rates are also now, coming down, they move into a little more riskier assets. And that's where the need for advice from the client side will even come in further. So that's going to be, generate more demand for advice.
Mr. Anand, at Axis Bank, you have Burgundy, which looks at HNIs. So dealing with HNI clients is different from dealing with a normal retail client. For IFAs here and watching this on television, what is your advice on how HNI clients are dealt with slightly differently from retail clients?
The way that we see Burgundy and our affluent proposition is not just about wealth management, and I think we are really presenting the entire capabilities of the bank to these customers. So if he's an SME, we are able to cater to his business needs, to his family needs, credit cards and loans and whatever else. And I think the most essential point there is to be able to make banking simple, to ensure that you get the interaction right every time, and it is on a one-touch basis, meaning that I have loads of data about the customer. And why should I keep asking him for the same data? Can I make that entire experience of banking very, very simple? Whether it is a high net worth customer or a retail customer, it is absolutely critical that you have at front and center the proposition that you have to do what is right for the customer.
Of course.
If you don't do that, you're doomed.
But Mr. Bhagat, this issue of trust, very important in this business, but developing that and maintaining that is the tricky part. How does an IFA maintain that?
Trust is difficult to get, but once you get it, I think you have to do something which is really, for the lack of a better word, really stupid to lose that trust. Okay, so in that sense, I think the way we've seen clients build trust over a long period of time is they want to see you remove the conflict between distribution and advice as much as possible. And if we can set up platforms and fee structures, if we can somehow arrive at a mix where the client is at peace with what we are making broadly as fees, and he's aware at some level that as an advisor I'm indifferent to the product which I'm selling. I think that's very, very powerful in the long run.
Lots more coming up on the Mumbai edition of the Financial Advisor Forums 2015-16. It's time for a short break. We'll be right back.
Do what is right for the customer. I think that is the most critical thing that you can do in financial services, because what you're selling is a promise of delivery into the future, and so therefore the customer is relying on you like a doctor. So therefore it's absolutely critical that you do what is right for the customer. You do that, the business will grow.
Welcome back. You're watching the fourth and the final Financial Advisor Forum of the season, coming to you from Mumbai. And I have 4 experts from the financial advisory community on the panel with me. So Mr. Arora, tell us, how can IFAs use technology? Because technology is ubiquitous, it is changing faster than you can say the word change.
I'll just break it into 4 steps that we actually do with the clients. First is when we try to understand what a client actually needs. Maybe bring out a first plan for him, or work out his liquidity needs, his requirements in future. We basically generate a first plan for him. And that place also is, you can have so many technology, I would say, tools available which you can do to, have a proper financial plan taken out for a client. And you should do that because it kind of, brings in a lot of credibility to what you're doing, and you're able to then, put it on a paper and take it to him and discuss it with him and then modify it if required on a digital platform. So I think that's the first step that you have to do. The second step is what, all of us feel very comfortable to do, but I would say that's a much lesser portion. Is then once the plan is ready, then just selecting, where to actually go and put. So you have the asset allocation place, you just kind of allocate, pick out the best funds, etc. That also, if you use technology properly, you have scoring models, you can, use research from different outfits which are, doing these, so it's credible. So it's not just saying that, I am saying this, there is also a third party also saying this, and this is the reason why I'm differentiating, or this is the reason why I'm going with what is being said. Builds a lot more credibility that it's not just you, it's what is coming through a known brand as well. The third stage is, I think, showing the consolidated view to the client, which is a portfolio statement or whatever, and it has to be regular. Give him real access, let him see whenever he wants to see, and then obviously the last stage which is there is review, and review again happens on that statement in coordination with what the plan is, and you kind of combine that. All these 4 major steps, if you look at them, are digitized today in different forms or the other. So you have planning tools, you have selection algos and things which are available. You have portfolio consolidations available, and for review you have things like robo advisory, which kind of maps your entire financial plan. So depending on your size, I think you could look at either joining something, taking an advice, taking to your client, or you could look at designing something on your own based on your own IPR.
It's time now to take some quick questions from the audience. Mr. Puri, first question comes up to you from Vidya Prabhu, ARN 7751. Why is this issue about disclosing brokerage income earned by IFAs on the statement of the investor?
First of all, I am not the regulator, just to be clear. So that, which is the right place to direct that question to. But I'll try and give you some sort of perspective on that. I think the issue around what is appropriate disclosure, as all of you know, has been under discussion for a long time. And there are already standards set for disclosure that distributors, advisors are in any case supposed to be sharing with clients some understanding around what their arrangements are and the relative commission across products. That is actually already in existence. I think what the regulator believes, and you may rightly question this, the regulator believes that it will help the market to build even more transparency if investors actually understand very clearly, that yes, there is a price that they pay for their advice, and they might as well know what that is. 2, they want the investor to be aware that they have a choice as to how they actually choose to invest. And this is the issue between direct and regular. So the disclosure issue is taking both these debates, if you like.
Mr. Anand, this is from Vikrant, I think ARN 39065. Why is there a move by regulators to over-regulate mutual fund space while all the parallel areas are far less regulated?
Post 2008, what we've seen is across geographies, we're seeing more, not less regulation, particularly within financial services. And I think that is something that all of us need to take cognizance of, and that this phenomenon is not going away.
Right.
We will continue to see more, not less regulation. Regulators across asset classes and including sort of the government, etc. I think do a fine job. You may not necessarily agree with everything that the regulator does at a point in time, but changes in regulation is something that even the mutual fund industry has gone through for years. the industry continues to grow from strength to strength.
And this is from Suresh Dhuri, ARN 102013. Is it not dangerous to sell mutual fund schemes online for investors? How many people in India are financially literate? So, Mr. Arora, if I could come to you.
Yeah, so when we are talking about, client buying it online, so buying it in online need not be purely a decision taken by the client by himself. So there are different kind of clients that, there's one set of clients who is a do-it-yourself kind of a client, and he could be reasonably savvy to invest. There is a second set of clients which is a much larger pie, is the set of clients who actually do the transaction online for 2-3 reasons. One is the ease of doing a transaction. He feels that he has full control on what he is doing. Unlike, when somebody comes and presents me a form and just asks me to sign on a place, he feels that by doing it myself, I have full control on what I'm doing. So that's an emotional issue and he feels more secure. Second is the visibility of the entire piece is there, but he still seeks advice from a human face. That's the kind of client which we will see evolving much more than the first category where it's do it yourself, because the complexity of the markets, investments is anyway growing further. But the client who wants to do the transaction, keep control on his investments, have an eye on it every time, but wants to check with somebody before actually executing a transaction. That's the segment, I think, which will grow, and with all these new changes, Aadhaar and KYC and eKYC, etc. coming in, it make it easier for that segment to even grow faster.
That's all the time we have this week on the Financial Advisor Forums 2015-16, presented by UTM Mutual Fund and CNBC TV 18. But stay tuned to the channel as we bring you a sneak peek into the jury rounds leading up to the grand finale of the Financial Advisor Awards 2015-16. Until then, from the entire team, many thanks for watching.
I think it's most important while dealing with clients to do 3 things. You need to be simple, you need to be modest, and you need to have client centricity in mind. Okay. So simplicity, modesty and client centricity very important, and all of us as IFAs, wealth managers, whatever we do, we need to remember that a client is coming to us for wealth management and not for wealth creation, because creation of wealth for all clients happen in their businesses. We really come post creation of wealth to manage it, which effectively means we need to preserve capital and beat inflation by 200-300 basis points on a consistent basis. So keep it simple, and if you persevere and work hard, success will be on the way.
Focus, ideate, innovate, enable.